Value investing is a popular but seemingly controversial investment strategy nowadays. It's a strategy that was propounded by Benjamin Graham and popularized by Warren Buffett and the late Charlie Munger. So I want to discuss how to succeed with value investing, and I'm considering 10 key principles in this particular content. Number one, intrinsic value. Intrinsic value is a very popular concept in value investing. It simply means the fair price, the fair value of the stocks of a given company. That is what intrinsic value is all about: the fair price, the fair value of the stock of a given company. Number two, margin of safety. Margin of safety essentially represents the difference between the intrinsic value of a company and the price at which the company stock is selling at the moment. As usually, as a value investor, you consider a margin of safety. In other words, if a company is valued at, let's say, $10, it's advisable you buy it at $5. That will increase your margin of safety. So the lower the price you are buying the stock at, the higher the margin of safety, because your downside in that regard is somewhat protected. And whenever the price climbs or increases or appreciates in the future, you will make sufficient profit out of it. And so the lower the price, the safer you are as an investor. Number three, long-term perspective. Value investors, invest with a long-time horizon. Invest with that knowledge and perception that in the long run, maybe over a year or two or three, your investments will then come out fine. The stocks must have appreciated and compounded in growth. And so you should not lose focus, on the long-term performance of the company you have invested in. As an investor, actually, the patience should be there, and the ability to have that long horizon should be part and parcel of, your investment strategy. Number four, focus on fundamentals. When it comes to value investing, your decision is based on the fundamentals of the company, and this will incorporate the quality of its balance sheet. When it comes to earning, the cash flow, how stable, how steady is the company's cash flow, how strong is the company's balance sheet, and the increase in its revenue, year in, year out. The fundamentals should be very, very strong. Once a company has a strong fundamentals, then even if the market goes into a downturn, even if the economy, goes into a downtrend, the company will not be so much affected. So it has the capacity to survive and to thrive even in a downtrending economy. Number five, contrarian approach. When it comes to value investing, you avoid whatever the crowd is doing. You are not affected by the herd mentality. You buy when others are selling, and you sell when others are buying. It might look like a lonely journey, but that's how you make money as a value investor. You should dare to be contrarian, dare to go against contrary opinion. And that is how you are going to effectively apply these particular principles in the markets to generate outsized returns. Number six, patience and discipline. And the market is bound to fluctuate. There's no doubt about that. That volatility is always there. That short-term fluctuation is always there. So as a value investor, it's necessary you remain patient. You don't get carried away by short-term fluctuation. And not only that, you are disciplined to wait for the number of years it will take for your investment to be able to grow and compound to the level that would meet up with your objective as an investor. And so patience is necessary and discipline is equally encouraged. Number 7, avoiding market noise. You must avoid, the noise that accompanies the markets on a regular basis. And this noise involves hype. It involves short-term fluctuation in the market. It's part and parcel of what makes the market what it is. And so we can't avoid, this noise in the market, but we should be able to make sure that they don't impact our investment decision making. We don't allow them to have a negative impact on how we go about maintaining our portfolio. And number 8, conservative financial management. As a value investor, you look at the strength of the company you're considering. You also make sure that the company is strong, in its industry. It has, that competitive moat around it. It can survive in a negative economic environment. It has a very strong balance sheet, very strong management, and it has that particular capacity to be able to resist, negativity in the economic climate. Please, I would solicit you subscribe to this particular channel and give me a thumbs up, as well as make a comment in the comment section, and don't forget to share these contents to people around you. Number 9, understanding the business. Before you invest as a value investor, you must have a thorough understanding of the business you are investing in. You don't just invest haphazardly. You don't just invest emotionally. Take your time to research the company you want to put your hard-earned money into. Research its fundamentals. Research its capacity to be able to grow in the future. Research its management. Research its performance in the industry. Research, even its business model. And so with certainty regarding this particular condition, you should be able to make it at the end of the day when it comes to realizing your investment objectives. And you must analyze, you must have that certainty that, yes, I'm investing in a company that is bound to do well in the future. And then lastly, diversification. As a value investor, you must diversify your investment. Even if you have cheaper stocks in a few industry or in a few sectors, don't be carried away by that. Make sure that you are well diversified. It's equally advisable you diversify even across geographies, across regions, and if possible, you go beyond your country of residence so as to be able to benefit from the positive outcome in other economies. And so by the time you apply this particular principle, there's a guarantee that at the end of the day, you will do better than any other person that is adopting, other strategies in investing in the market. And so this is a proven strategy adopted by the world most the world richest investor, Warren Buffett. This is the strategy he adopts. And many other popular, investors equally, adopt this particular strategy, and is doing very, very well for them. Although it's controversial nowadays, people believe that value investing is dead. But personally, I don't believe it's dead, because we will end up still having a tendency to buy stocks that are cheap. That's essentially value investing. And so it will never ever go out of fashion. It will remain, an in thing for a long, long time to come.